Hello everyone, and welcome back to the Quant Lab. In our previous session, we discussed the philosophy of reversals and physics of momentum decay. Today, we put that theory into practice by looking at our first and most famous bottom fishing macro trigger, the hammer. Bottom fishing patterns are designed to catch falling knives. They appear during established downtrends and signal that bear risk momentum has completely exhausted itself. The sellers have capitulated and massive institutional capital has stepped in to establish a concrete floor. And no pattern visualizes this capitulation better than the hammer. In retail trading, people look for a candle that simply looks like a hammer. In quantitative trading, we use strict mathematical constraints. First, we look at the structure. Let B represents the absolute length of the real body. The lower shadow, or wick, must be incredibly long. It must be at least twice as long as the real body. Okay, it will look like this. So this length should be at least twice of this length, or B. Furthermore, the upper shadow must be visually non-existent, right here, strictly kept at less than half the size of the body. In other words, this length should be less than half of the length of the real body, or B. If the upper wick is too long, it is not a hammer. It is a spinning top, which indicates indecision, not reversal. Second, we check our filters. A hammer is mathematically meaningless if it does not occur after a prolonged, mathematically defined downtrend sequence. Finally, the hammer must exhibit a confirmed volume increase. A massive volume climax provides the highest statistical reliability that institutions are actually present. Notice that we do not care if the closing body is green or red. The color of the consensus is secondary to the extreme length of that lower shadow. Why is the lower shadow so important? Because it represents a massive liquidity sweep. Imagine a stock has been crashing for weeks. Retail traders are panicking. The algorithms intentionally drive the price down to a new absolute low, specifically hunting for retail stop-loss orders. As those stop-loss triggers, a cascade of supply floods the market. But instead of the price collapsing further, intense institutional buying pressure steps in. The institutions absorb every single dumped share and aggressively force the price all the way back up to close near its highs. That massive lower wick is the physical footprint of institutional absorption. Now, I must share a quantitative secret with you. Not all hammers are created equal. The mathematical reliability of a hammer depends entirely on its macrostructural relationship to the previous day's candlestick. We rank them into three categories. Rank 3 is the Harami hammer. This is the weakest variation. Here, the hammer prints entirely inside the body of yesterday's candle. Because it fails to drop below yesterday's low, it never sweeps liquidity. It is merely a pause in volatility. Rank 2 is the gap down hammer. This is a moderately efficient. The price gaps down at the open and prints a hammer. However, because it leaves an unfilled gap right here, immediately above it, that empty space will act as heavy algorithmic resistance, making it much harder for the stock to rebound. Rank 1 is the pure racing hammer. This is the absolute premier setup. The opening price drops lower than yesterday's lowest value. A terrifying wick hands into selling, but the buying pressure is so intense that the closing price pure races back up and closes higher than yesterday's low, deep inside the previous day's body. This perfectly executes a liquidity sweep and immediately traps short sellers in a losing position. So, how do we execute this? When a highly efficient hammer forms at a known macro support zone with expanded volume, we enter a long position near the close of the body. But we must strictly define our risk. The absolute lowest point of the hammer's wick serves as our strict natural stop loss. That exact penny is where institutional capital stepped in. In other words, we buy near here or here, close to the closing price, and the stop loss point. So we sell the stock exactly at here. Okay. When the closing price get down lower than this value, we have our stop loss. We sell the shares that we buy right here. Okay. So let's look at two examples. Look at this chart of LULU. A beautiful piercing hammer forms, sweeps the liquidity, and launches a massive macro reversal. Okay. You see a hammer, volume increase, and we see this reversal. But now, look at this failed example. The hammers print right here and here. But the bears fall to defend the zone. Within a few days, the price definitively breaks and closes below the absolute lowest wick of the hammer. Like here. The structural floor has fractured and the setup is mathematically invalidated. Our stop loss executes to protect our capital. Never trade a hammer without respecting its absolute low. In our next session, we will invert this logical and study the inverted hammer. See you in the Quant Lab.